Welcome back. Let's revisit the huge market meltdown of the last few days and check out what is the danger to the US and the global economy, not just markets. Now, the markets tanked because the US created only 114,000 jobs in July versus market expectation of 175,000, and because of the so-called unwinding of the yen carry trade. But what hit the market badly was a supposed rule called SAHM rule, SAHM, which argues that if the 3-month average of US unemployment is 50 basis points more than the previous 12-month low, then the economy is in for a recession. To understand more about both US recession and the yen carry trade, I have with me Jahangir Aziz of JPMorgan from New York and Mitul Kotecha of Barclays joining from Singapore. Gentlemen, thank you very much for your time. And Mitul, with your permission, I'm asking Jahangir first. He's staying up for us. Jahangir, now how much should we worry about a concept like the SAHM rule? Because the 3-month moving average is 4.15 and the low of the last 12 months is 3.6. So clearly 50 basis point over the last, 12-month low. So is there a likelihood of recession according to JPMorgan?
So we're not. So I think the SAHM's rule is useful, but it's a backward-looking rule. It doesn't really tell you what is going to happen in the future. It tells you that if in the case this happens, then chances are there will be a recession. As we have talked about, innumerable times with you, Latha, this time around, the dynamics of the business cycle are very, very different. And that is the reason, if you go back, let's say, to December of 2022, we had an equal sharp drop in non-farm payroll, and everybody screamed and shouted, well, 23 is going to be a recession. 23 turned out to be one of the best years for the US economy. So we are not calling for a recession. Having said that, I think what this shows to us is that it is making it much more stark, the asymmetry in Fed reaction. So the way in which we have been talking about the Fed is that, look, as long as inflation is coming down and the Fed is feeling confident that inflation is going to meet its 2%, 2.5% target, then the Fed should start cutting rates because the Fed has kept rates at a very restrictive level. The issue is that if that's the only thing that's happening, then the rate cutting cycle would be shallow, calibrated, and extended till the end of 2026, which is basically what's in the SEPs, the dot plots. I think the asymmetry is that if this was also accompanied by a weakness in the labor market, then that would bring forward the Fed rate cutting cycle. I think what the non-farm payroll on Friday showed that the gapping down of the non-farm payroll, I think that wasn't the big driver because, a large portion of that was probably a reflection of Hurricane Beryl's impact in the Midwest and in Texas, right? So chances are that it's going to recover probably next month. It was what was inside the payroll report. So for the first time, we saw that wage growth was much slower than the past, and more importantly, that the layoffs were turning to happen.
Yes.
And so it's a combination of the details, not so much as the gapping down, but the details that brought about the change that now we have downside risk on inflation. Remember, wage growth is much slower, and we have downside risk on labor market. So both the boxes that the Fed is worried about, both their mandates have downside risk, and that's the reason we have brought forward our rate easing cycle. We have brought it forward quite aggressively. Okay. So previously we had a 25% start in September, another 25% this year, and then every quarter we want to rate cuts. Now we have 50 in September, 50 in November, and then every meeting, not every quarter, every meeting we have 25, so that by the end of July of 2025, we reach a terminal rate of 3% instead of N26. So it's a huge difference, a huge change that has happened to the Fed call.
Okay, and I agree. And the market seemed to have brought forward that expectation, if you go by the way the dollar and the yields have moved. Mitul, on that note to you, Jahangir told us about the SAM rule, can you explain to us the yen carry trade and its unwinding? How intense is the unwinding, and can we see more of it?
Well, look, I mean, firstly, I would just say about our view on the US. I mean, look, we've actually got a bit more of a hawkish view. We do expect free cuts this year from the Fed and free cuts next year, but we're looking at a terminal rate that's not as low as the market's pricing in, or as Jahangir just mentioned, the 3%. So we don't think the Fed will need to cut as aggressively. And I think that's been a factor. We talk about the yen carry trade, and look, the Bank of Japan hiked rates. We had expected that, but it happened at a time when we had a confluence of factors affecting markets. And clearly the carry trade unwinding, which has been very, very severe indeed. And we know that Japanese investors had a huge amount of outflows into emerging market carry and higher carry trades globally. And the ability or the amount of repatriation of that has been fairly significant. But it's also led to a broader global carry unwind. And I think the yen has been the key funder, but we've had a number of funding currencies globally, such as the likes of Swiss franc or CNH in Asia, Taiwan dollar. And we've seen a big shift in a lot of these funders. Now, I think how much is there to go? We probably don't see that much more to go in our view. We've seen a very, very aggressive move as it is. Even today in markets, we're starting to see a little bit of a bottoming forming. It could be early days, and you don't want to catch a falling knife. But clearly, this market has been hit by whether it's worries about the U.S. economy, whether it's worried the extent of Fed rate cuts, and that's been a driver of this dollar-yen move as well, with yield differentials between the U.S. and Japan narrowing, whether it's geopolitical concerns and in the Middle East, or whether it's equity valuations, in particular AI and tech. It's so many factors in a time when liquidity is thin, at the time when would have normally expected to see summer quietness. It's a tight liquidity, difficult environment. So I wouldn't be surprised to see more volatility in the weeks ahead. But I do think we've seen probably the brunt of this move in terms of carry trade unwinding. We've already seen a lot of position shifting, and I think positions are moving closer to neutral. As an example, our dollar position sentiment index is already quite negative. So we've already seen a very, very sharp shift in dollar sentiment, and it's unlikely to see a further shift too much more negative from here.
Okay. That's very useful. In your reckoning, it's probably 75 basis of cuts in 2024, and Jahangir, of course, just told us they are expecting 125. And I think the CME Fed Watch is also indicating that 125, but things might change. Well, before I come to you, Jahangir, Mitul, therefore, at the moment, the dollar index is 102.78. It was, of course, 104.5 on Wednesday or Thursday before all the turmoil began. Are you saying that the dollar index is more or less there and we shouldn't expect too much falls from here on?
Look, you can't rule out more downside in the dollar. But, the reality is that this is not necessarily a dollar move, right? I mean, if you look at most major currencies except the yen, it's not been a dramatic move. This is a pure carry unwind. It's a selling of high yielding, high carry currencies. And no better place to look than, say, in Latin America when you look at the likes of Brazilian real, Mexican peso, and in India, the same with the rupee. It's the relatively high carry currency in this region, and at the same time, it's that unwind, and it's the low yielders that have been positioned most negatively that have seen the biggest benefit. So I think the dollar's got caught up in this, and of course has been pressured because of the more aggressive rate cut pricing that the market has been pricing in more recently. And so there may be a bit more dollar pressure. But look, if we are right and that the market is already pricing a lot for US rate cuts, it's probably likely that, and also we add in the positioning and sentiment, it is probably likely that the dollar has not got too much further to fall from here. And we may again have seen a large extent or large magnitude of that move already having been taken by the market.
Okay, got that. Do you expect the yen to strengthen all the way back to 160? I mean, weaken all the way back to 160? Because the yen seems to be the root of more trouble than the other carry currencies.
Well, that's fair. Look, I mean, our forecast has been 160 as top in dollar yen, and clearly we're way away from that now. I think it's unlikely we see the sort of rebuild of carry trades that we've seen in past months, especially given that yield differential and especially given that the Bank of Japan has now tightened policy. But at the same time, I think we are approaching better levels for investors to start putting back on these trades using the yen as a funder. If we look at yield differentials, dollar yen is pretty much bang in line with where yield differentials would be expected. So, I think, again, it's the same story. A lot is priced in dollar yen, and probably the risk reward may favor an upward bias in the weeks and the months ahead for dollar yen.
Oh, upward bias. Okay, so we are not going to see more unwind. Just a final question. I know you're in a hurry, Mitul. What is your range for the dollar rupee, and are you expecting anything from the Reserve Bank in terms of cuts?
Yeah, look, firstly, let's say the second question. Reserve Bank, we don't expect the RBI to cut quickly. We have been penciling in a December cut from the RBI, but clearly the volatile food prices have had an impact on inflation, as we saw in the last reading. And so we would expect the risks are skewed perhaps to an even later cut from the RBI, even if the Fed cuts earlier and more aggressively. We know that India is not necessarily on the same path. Indian growth is still far stronger, and inflation is a bit more stickier on food prices. So, look, we think the risks are perhaps for a delay from the RBI, but we'll see at the next meeting and clearly see how or whether the RBI is looking at the Fed in any way and perhaps sounds a bit more dovish. We doubt it. We're looking at liquidity as a factor here. And for dollar rupee, look, the rupee has underperformed. And I think, part of that is the RBI continuing to soak up dollars, building FX reserves. And we would expect some of that underperformance to continue with perhaps that sort of move up to this sort of higher range that we've been in now. But again, I wouldn't expect to see the rupee fall significantly from here. I think we're just probably in a new higher range rather than any sharp moves. And I think volatility is still going to be very well contained by the central bank.
Oh, yes, it's almost not moving certain days. Thank you very much, Mitul, for getting time for us in spite of a very busy schedule. And Jahangir, thank you for your patience. Well, I just want to come back to the US for a bit. Is there a higher recession chance, according to you?
No, because intermediate cut is for an emergency, right? So emergencies are typically financial market scares driven by disruptions in the credit market or the breaking down of the interbank market. Nothing has happened to credit spreads. Nothing has happened in the interbank market. Yes, the equity markets have sold off, but you can't blame recession risks on that. You have to go and look at the bigger culprit, which is the reversal that has happened to the yen carry trade, right? Because of the yen appreciation and the rise in yen rates. That's driving most of this leverage, buying of equities or emerging market carry trades, including in India. Let's not forget what's happened in India. So that's much more to do with what has happened to yen as a funding currency rather than people suddenly realizing, well, a recession is around the corner. I don't think that's the reason as to why you've seen the bloodbath in the US market.
Okay. I want to know, will you bring down emerging market growth? If you're expecting some kind of slowness in the US, then are you expecting some kind of low growth headwinds for emerging markets and more particularly for India? Will you lower the growth?
So let's not, forget that there is another big variable called China, right? So both the engines of emerging market growth, one hand US, the other hand China, both are slowing down. And the slowdown in US probably in comparison to second half of 2023 is much sharper than, let's say, the slowdown in China, which is there, but it's not as dramatic as the slowdown in the US. So I think the combination of the two of them necessarily will start showing up. And you can see that in the manufacturing PMI numbers of the last 2 months across emerging market, particularly manufacturing exporters and Asia. We have seen manufacturing PMI slow down. You've seen the drop-off in Chinese PMI numbers. So I think that is obviously part of the course that you are going to see this happening. But at the same time, you should also not forget that domestic demand in emerging markets, particularly in Asia, had remained weak, had not recovered from the pandemic. It continues to benefit from a decline in core inflation. Core inflation today in India is probably on a 9-month low. And I think that we should not lose sight of the fact that domestic demand probably is getting boosted up. And so I think that the combination of the two of them will probably slow down growth, including in India. But I do not think that this is something that we should start panicking.
Okay. No, not panicking. It's just that there is an RBI policy upcoming that I was discussing with Mitul as well. Do you expect, I mean, if not a stance change, at least more dovishness from the RBI?
I think that the language will have to be brought down, right? I mean, if the 10-year has gone down from 450s to 3.380s, right? Yes. You know, the RBI cannot say that financial conditions, global financial conditions haven't really quietened down a bit, right? Now, clearly, there's now pressure on the INR, right? It is fine that it is because of the reversal of the yen carry trade, but as far as the RBI is concerned, it is pressure on the INR, including there is this question about food inflation. So my guess is that it will tone down their rhetoric, tone down their hawkishness a bit, but I don't think they will signal a shift in stance. I think they still remain worried about credit growth, including in uncollateralized credit growth that has taken place. So my sense is that they'll tone down their hawkishness a bit. They're not going to say we're changing the stance. I think they will wait for the September cut. And if we are right and the Fed delivers a 50 basis points cut in September, I think in the very next meeting, the RBI has to cut.
Okay, very next would be as early as October. Thank you very much, Jahangir Aziz, for staying up for us and for giving us your idea on the JPMorgan view of recession. Not a recession, according to JPMorgan, but clear slowing down. And they are expecting 2 50 basis cuts, one in September and one in November. In the US, another 25. So that means an RBI rate cut can be expected in 2024 and perhaps even before December. But let's wait and see. Makes the RBI policy much more interesting. On that note, we wrap up on Bazaar. Chartbusters coming.